Welcome to today's Financial Insight video presented by TCGA20 LLC. We're diving into the stock market to simplify how it operates. Whether you're looking to invest or just curious about the intricacies, this video is for you. Let's decode the complexities of the stock market together. Stay tuned. Understanding the stock market. The stock market functions through a network of exchanges, such as the New York Stock Exchange, NYSE, and NASDAQ. These platforms facilitate the buying and selling of stock shares from publicly traded companies. When you buy a stock, you're essentially purchasing a small piece of that company, becoming a shareholder. As a shareholder, your investment can grow in two main ways: through increases in stock price and through dividends, which are shares of the company's profit paid to shareholders. Stock exchanges serve as a vital meeting point for buyers and sellers, using a system of market makers and electronic networks to ensure trades are executed efficiently. The price of each stock is driven by supply and demand dynamics, influenced by factors like company performance, economic indicators, and market sentiment. Understanding these basics is crucial for anyone looking to invest in the stock market. Buying and selling stocks. Investors buy and sell stocks through brokers, who act as intermediaries in the market. Brokers facilitate the exchange of stocks between buyers and sellers, providing a platform for these transactions, which can be done through physical brokerage firms, or more commonly today, via online trading platforms. When you decide to purchase or sell a stock, you can place various types of orders. Market order buys or sells a stock immediately at the best available current price. Limit order sets a specific price at which you want to buy or sell a stock, ensuring you don't pay more or receive less than this price. Stop loss order, designed to limit an investor's loss on a position by initiating a sell order if the stock falls to a certain price. Understanding these options is key to effectively managing your investments and ensuring you execute trades at favorable times and prices. As the stock market is subject to fluctuations, strategic use of these orders can help protect your investments and potentially secure profits. Market prices and their determinants. The prices of stocks in the market are primarily determined by supply and demand. This fundamental economic principle dictates that the price of a stock will increase if there are more buyers than sellers, demand exceeds supply, and it will decrease if there are more sellers than buyers, supply exceeds demand. Several factors influence these dynamics, including company performance, earnings reports, revenue growth, and future earnings guidance can significantly affect investor sentiment and thus stock demand. Economic indicators, interest rates, inflation rates, and unemployment figures can sway market trends and influence the overall investment climate. Market sentiment. Often driven by news and events, sentiment can rapidly shift stock prices. Positive news may drive prices up, while negative news can lead to sell-offs. Technical factors. Many traders use technical analysis to predict price movements based on historical data and trends, which can lead to self-fulfilling prophecies as traders react to anticipated price movements. Understanding these factors is crucial for investors aiming to make informed decisions about when to buy or sell stocks. The more adept an investor is at interpreting how these elements may impact stock prices, the better they can potentially maneuver through the complexities of the stock market. Understanding market indices. Market indices like the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite are essential tools for tracking the performance of specific segments of the stock market. Each index serves as a benchmark for its respective market, offering insights into the overall health and trends of the financial markets. Here's how they work. Composition. Indices are composed of a selection of stocks that represent a sector or the market as a whole. For example, the S&P 500 includes 500 of the largest companies listed on stock exchanges in the United States. Calculation. The value of an index is calculated based on the prices of its constituent stocks, often weighted by market capitalization. This means companies with larger market values have a bigger impact on the index's performance. Usage. Investors and analysts use indices to gauge market trends, compare stock performance, and manage investment portfolios. Indices also guide investment funds, like index funds and exchange-traded funds, ETFs, which replicate the performance of a specific index. By understanding market indices, investors can better assess market movements and make more informed investment decisions, aligning their strategies with broader market trends. The role of regulation in the stock market. Regulation plays a critical role in maintaining the integrity and stability of the stock market. In the United States, the Securities and Exchange Commission, SEC, is the primary regulatory body that oversees and enforces federal securities laws. The SEC's objectives are to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Here's how regulation impacts the market. Investor protection. Regulations ensure that companies provide essential and transparent information to investors through filings such as quarterly and annual reports. This transparency helps investors make informed decisions and protects them from fraudulent practices. Market surveillance. The SEC monitors trading activities and investigates unusual trading patterns that could indicate insider trading or market manipulation. This surveillance helps maintain fair trading practices. Compliance and enforcement. Companies must comply with a wide range of regulatory requirements regarding their financial reporting and trading activities. The SEC has the authority to impose penalties, sanctions, or pursue criminal charges against violators, which serves as a deterrent against misconduct. Market confidence. Effective regulation boosts confidence among investors that the market is fair and that they are competing on a level playing field. This confidence is crucial for the smooth operation of financial markets and for attracting domestic and international investors. Overall, regulation is fundamental to ensuring that the stock market operates transparently and efficiently, safeguarding the interests of all market participants and promoting a healthy investment environment. Market hours and their importance. The stock market operates within specific hours, typically from 9:30 a.m. to 4 p.m. Eastern Time, on weekdays for major exchanges like the New York Stock Exchange, NYSE, and NASDAQ. These hours are crucial for several reasons. Liquidity. During official market hours, liquidity is highest, meaning there are more buyers and sellers. This high level of liquidity makes it easier to execute trades at predictable prices without a significant impact on the stock's price. Volatility. The opening and closing hours of the market are often the most volatile parts of the trading day. Many traders look to capitalize on this volatility, which can be driven by the release of economic data or news events that occur after the previous market close or before the market opens. Thank you for joining us on this exploration of the stock market brought to you by TCGA20 LLC. If you found this guide helpful, don't forget to like, subscribe, and click the notification bell for more updates. Have questions or topics you want covered? Drop a comment below. See you in the next video.